Hello sector watchers, welcome to the show. This is the 121st episode of Sector Spotlight for Tuesday the 5th of April, and I am recording it on Monday the 4th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you want to share anything with me, provide feedback, have any questions, please use any of the channels on the screen. It is the first Tuesday of the month, and in Sector Spotlight that means that we will spend a lot of time on going over the monthly charts for asset classes as well as sectors. Obviously we will start off with a quick overview of last week's rotations, see if we find any meaningful changes, anything that we can get some guidance from, and then we'll move on to a look at the monthly charts for asset classes and sectors, and that'll probably going to take up all of our time. So let's not waste any more. We're going to start with an overview and then move on to monthly charts in Sector Spotlight. Starting with the rotation of asset classes. On the right hand side we have the daily RRG, on the left hand side we have the weekly RRG. If we start at the right hand side on the daily version, then we can see that stocks, SPY, are inside leading, but they started to roll over last week. Over the last 5 days they started to lose relative momentum. On the opposite side we see the fixed income ETFs, GOVT, LQD, HYG, starting to pick up, so moving counter to the stock market. And the same goes inside weakening for VNQ, which started to pick up relative momentum. The commodity ETFs, DJP and GSG, are still inside weakening, but they continue their improvement in terms of relative strength, relative momentum. They continue their improvement in relative momentum. They're still losing on the horizontal, the JDK-RS ratio axis, so they're still losing relative strength on the daily scale, but they are moving higher on the RS momentum axis, and we will look at that in combination with the weekly in a minute. Same goes for VNQ, that is rotating back towards the leading quadrant. Now if we bring that over to the left hand side to the weekly, then you see and that's the story of the last few weeks, that both commodity ETFs are way out inside the leading quadrant, top right hand corner, and they are distorting the image that we have for the weekly chart. So again, I'm going to tick those off and refit the rest of the tails, because we do know that commodities are way up there. And then you see that VNQ and SPY are sort of, VNQ is in line with what we see on the daily, but SPY is rotating back up, and GOVT and HYG and LQD inside lagging are rotating lower. So from a relative point of view, that means that SPY, stocks and real estate are actually picking up in strength versus VBINX. Whereas GOVT and HYG and LQD are losing relative strength, and the US dollar lost a little bit of relative strength, but it's very, very high on the RS ratio scale, while commodities are the strongest way out there. And when I looked at this, I sort of had to think about, hang on a minute, that means that stocks are getting back in favor, and I have a hard time making that click in my mind because of a few reasons that I will discuss with you in a minute. So the thing that you really need to understand here is that these RRGs are based on relative strength. So they are comparing GOVT and SPY, for example, with VBINX. So despite the fact that we will see, and that it's clearly visible, that there is an improvement for SPY and VNQ, and there is a further weakening for GOVT and HYG, and definitely for corporate bonds, LQD, it's now, this is a situation that we haven't seen for a long time. It's now very important to also have at least a quick look and be aware of how the chart of the benchmark looks. So that's VBINX, to put all of these rotations into perspective. And if we bring up the chart of VBINX, then this is the weekly version. And you can see that we had that massive uptrend that lasted for 2 years, maybe even longer. And I think that uptrend ended at a big double top. We dropped out of the rising channel. We tested support, we dropped again, and we're now coming back to that old support level. It's acting as resistance. And yes, I know, and we'll look at the chart of SPY later on. As a matter of fact, let's do that right away. If you look at the chart of SPY, then it bounced off its support level. It's challenging that 460 area. I think that's a very important area. You see it a little bit better if you look at the daily version. You can see that 458, 460 is now tested 3 times. We had a support here, break, 1, 2, and then we tested it last week, dropped back, and we're now going back up to that area again. So that 460 is important. I don't judge this S&P chart as a very bullish chart. I think it broke resistance, low highs, low lows. So this first leg of a downtrend is there. We're now challenging this previous high. Will this turn immediately back into a strong uptrend? I really doubt it. I really, really doubt it. What I do see is that this rally is stronger than the rally in bonds, and this decline was probably less fast than the decline in bonds. So we are pushing to new highs in the ratio of SPY versus VBINX. If you look at the chart of IEF, I think that's where the real danger is coming from. Look at this massive head and shoulder that's completed. We labeled that in the sector spotlight a few weeks ago, maybe a couple of months ago. And we're looking at 103 for IEF. And if you translate that to treasury bonds, 10-year treasury bonds, then we're looking at yields of 3%. Now, rising yields generally are not very good for the stock market, especially not when they're rising very fast. And the fact that we see the tails of SPY and V&Q rotating back up versus V&Q versus VBINX is simply because the bond chart is looking even worse than the SPY chart. This is not too bad. I don't like it. It's not too bad of a chart. If you look at IEF, that's really a bad chart. So please remember, this is all based on relative strength. In relative terms, stocks are picking up against bonds, high yield government bonds and corporate bonds as well. In absolute price terms, I am still very, very cautious with positions in the stock market, because I do think that we have seen a break of the uptrend, and I think we do need to see more upward, and probably more in terms of higher highs and lows. I just don't see this move out of that 420. If you take the lows here, 415, one straight leg up, moving towards 480 and higher. It's with this type of interest rate charts, I find that very hard to believe, and we'll have a couple of other arguments when we look at sectors. Last thing that I want to mention to you is the US dollar continues to strengthen. We're sort of in a pause here, but we're nicely moving towards higher highs, higher lows. I'm watching about 99.5, pushing above 99.5 will probably give the dollar another boost versus this basket of currencies. Moving to sectors and sector rotation. Again, on the right-hand side, the daily RRG for the 11 S&P sectors. Nicely spread out universe, some nice rotations visible. And on the left-hand side, we have the weekly rotations. As over the last few weeks, pretty distorted by the tail of XLE energy way up inside the leading quadrant. So what I just did with commodities and asset classes, I'm going to do with the energy tail in sectors, and take it away, because we do know that it is in the top right-hand corner over there. Let's see what happened over the last few weeks. Well, over the last week, I have to say. We see strength for technology and discretionary together with materials. All three are inside leading. And if we look at the rotations on the weekly, then we see that that strength is translated into an improvement, a slight improvement for both discretionary and technology. Tails are still inside lagging, so they're still in relative downtrends versus the S&P 500. They're picking up a little bit of momentum. We'll have to wait and see whether they'll be able to make it, whether this is the start of a complete rotation back towards leading, or will we see more weakness ahead. That's very early call and too hard to make at the moment. We do say is that materials continue strong inside leading. Short tail means that it's a stable trend. And if you look at that here with the rotation on the daily, that's moving back towards the leading quadrant. So materials seem to be in good shape. Another sector that seems to be in good shape is communication services. And I know it's still way down on the RS ratio scale. Very low, very strong relative downtrend. But its tail has shortened, so it's stabilized at that, wrong chart, stabilized at that very low level. You can see that right here where that strong improvement that now sort of slowed down. You see that tail shrinking, and now it's sort of meandering, hovering around that 100 level. The tail, the direction of that tail is good. The heading is good. It's moving into the improving quadrant. And if you look at the daily tail for XLC, that's moving inside the improving quadrant quite rapidly, started to accelerate now towards leading. And despite the fact that that long-term chart is still not very strong, if you've seen last week's Sector Spotlight, where we always talk about seasonality, because that's the last Tuesday of the month, then you may remember that based on the seasonal pattern, communication services actually stood out as one of the two potentially strong sectors for the coming month, for the month of April. And when I was preparing for today, I had to think about what we talked about last week with that strong seasonality, that strong seasonal pattern for communication services. And it definitely looks as if we're going to get a little bit of that. Because we do see some strength on the daily. We do see that carrying over to the weekly. And despite the long-term weakness, both price and relative, there is a very good chance that seasonal patterns, seasonal strength is going to help communication services ahead in the coming maybe couple of weeks. I don't know, but it's definitely something that we should keep an eye on, because this seasonal pattern is very likely going to help communication services going forward. We'll have a look at the chart in a minute. What I also see here is utilities rotating back up, picking up new strength. We see staples went through weakness, but it's now starting to pick up and move into improvement, into the improving quadrant. We see healthcare now losing relative strength, not much momentum, but losing relative strength. And what others? We had talked about this, financials moving further down here inside lagging, and we see industrials also pushing further into the lagging quadrant. Now, the translation that I wanted to make, because we've been talking about all this strength in defensive sectors. And if you look at the weekly, that's still sort of the case, because utilities is now at the top of the league. It's the highest reading, except for energy, but after that, utilities is the strongest reading in terms of RS ratio. You see that healthcare is sort of moving sideways, lost a little bit, tails be shrinking. And we see staples, it's the third energy utility, staples, losing relative momentum, but still high on the RS ratio scale, so still in a nice relative uptrend versus the S&P 500. Those are the defensive sectors, and if you look at the tail for XLP on the daily, then you can imagine that if this strength on the daily continues, it will eventually pull that XLP tail on the weekly through weakening and back up towards leading. So my judgment, my take that the strength of the market at the moment is still very much carried by strength in defensive sectors, where it's very hard to make that click with a super strong new or continuing bull market, especially when you combine that with the rapidly rising yields, especially in the 10-year. I know that there's already people watching for an inverted yield curve. Maybe if you take some very exotic combination of yields, then that's happening. But the 10-2-year yield curve, which is sort of the de facto yield curve, is not there yet. But I can't rule out that it will happen in the next few weeks. Now, if we look at a few of those individual charts, then I told you communication services. this chart is negative. This is a downtrend. But look at the recent rally, and there is still some upside potential towards this trend line is around 72.5, where that former support level, now resistance, is found. If we reach that in the next few weeks, then that is the seasonal strength that we saw on the seasonal pattern. Energy remains very, very strong. Technology is struggling with its overhead resistance around 163. Discretionary is sort of doing the same. You can see the resemblance with the S&P 500 chart if you look at tech and discretionary. Consumer staples continuing higher inside its trend, just seems to be getting away from that consolidation, while strength's holding up well. And then here is utilities. Utilities breaking to new highs. This is the most defensive sector that we have, and it's breaking to new highs. I don't think that's a very bullish sign for the market as a whole. And then we have healthcare, which is holding up very well in terms of relative strength, and it's back into its uptrending channel as we've seen it since, well, somewhere June of 2020. We start with the monthly chart for the S&P 500, and obviously that long-term trend is still very much there. But the shorter-term part definitely got some damage. If you look at what I started to do, look at the downside risk, which I labeled over the months, and we're going to get the table with the sector risks at the end of the show. Then you can see that for the S&P 500, we closed the month here at around 4530, 4529. The first support level is last month's low. That's around 4100. That's about 9%. The next one, and we're all looking at monthly charts, we're looking at absolute price levels, that is about 20% lower. So your downside risk is about 10% initially, and then the next level is about 20%. If you look at the upside potential, this month I started to add upside potential because we've come out of a period where there was no upside, well, the upside potential was unlimited because they were always making new all-time highs and new closing highs. That is now gone, that's over. We have overhead resistance levels very clearly visible on our monthly charts. That's bad news because we're not unlimited anymore to the upside. The good news is that we can add some upside potential. And for the S&P 500, I'd say that's about 7%, 6.8. From current levels to the all-time high level here, that's around 7%. So you can make your own, draw your own conclusions about whether that's a favorable risk-reward ratio in terms of monthly price changes, because this is really long term. But for me, it means that we're pulling back to old levels. The initial move down is about 10, next one is about 20, and on the upside, we're sort of capped around 4,800, which is about 7%. I'd be very, very selective with that. If you look at IEF, this is the chart that worries me most. This is a very clear downtrend. We broke all these support levels. We've already seen the weekly chart, but here you can see how important that 100 level on the IEF is. And that's a serious decline in terms of fixed income. So Please keep an eye on this 10-year chart, the 10-year yield, but this is then the ETF, because I think this is where the danger, this is where the threat is coming from for the time being. If you look at DJP, we're running into resistance, and the same goes for GSG. That's also running into resistance. After the rallies that we've seen in commodities, that's not really strange. There's plenty of room for these markets to sort of settle down, take a break, take a pause, maybe pull back without harming that big turnaround base, that big reversal pattern in commodities. And over time, we will very likely see higher prices in the commodity markets. US dollar, as I said, continues to strengthen back above its former trend line. Could even go to 104 if you take a little bit more conservatively. It's 101. There's still plenty of upside for the dollar. And if you look at the yield curve, then we're approaching zero. That's a flat yield curve. We are flat right now, and we're going to watch this for a potential inversion of the yield curve. And then wrapping things up with a look at the monthly charts for the sectors. We're not going to go over all of them, because some of them are less interesting. So I highlighted a few, and then at the end we'll do the table which we show all the risks and potentials for all sectors together. So here we have the communication services. As again, seasonal looks to be good for communication services. And if you look at the downside risk, because it's a sector that already went through a lot of downside, so the downside risk is still there, but it's getting less and less as long as it's approaching very serious support levels. But it also means that the upside potential is relatively big for this sector. So here you go for communication services. Here is consumer discretionary, and you can see that this chart was damaged. There's quite some downside and about 16% of upside. I'm looking at the previous highs and lows to determine what the potential, upside potential and downside risk is. Here is consumer staples. This uptrend is very nicely intact. Because it's so strong, the upside potential towards the next resistance level is relatively small. Downside, again, also, it's much less than for other sectors. And that's because this is still in a nice uptrend. Energy is the sector that came out of that long-term downtrend. And it has still a good run up to the previous all-time highs. It's about 27%. And we're now challenging resistance in that 580 area. And from there, the downside is it's around 20%. 17 or 22 is the level of the former resistance line. It's now acting as support. And if we get above that resistance, we tried it a little bit during last month, then there is another 25, 27% potential left. If we go to healthcare, again, that's one of the defensive sectors. The uptrend is still intact. We managed to hold up above the previous low around 1450. That's the 9% downside risk from current levels. It's about 12 when you go back all the way back to the former resistance line. And again, this is a sector that is still in an uptrend, still very close to its all-time highs. So the upside potential is relatively limited. Again, obviously, when it breaks through that resistance, there is new upside potential will be unlocked. Here we have information technology, just like discretionary. This chart was definitely damaged. We're in broad range right now. We're holding up above support around 2480. That's about a 12% risk. And then if we go back to the next cluster of highs and the previous low, that's around 22%. About 11% upside potential for technology until the previous all-time high. And then finally, and I can't stop talking about it, it's the utility sector. This is the only sector that's making a new high this month. It's the only sector that's at a new closing high this month. It's got very limited risk because it just broke out, so that's 4.6% downside risk to the previous level, and then the next cluster is about 14. And the upside here is like unlimited because there's no reference point in the past. So again, with utilities being the strongest sector probably together with energy in the whole universe, I think that's a risk. It's a warning sign for the market as a whole. Now, if we bring all this together in the table, you know this table, we talked about this for months already. The only thing that I've added is a column with upside potential. So here are all the sectors, the ones that we just discussed, and also the ones that we did not discuss. And it's showing you the weight, the downside risk, and the upside potential. And give or take, I think that the downside risk for most of these sectors is still outweighing the upside potential. So definitely risks still present in the market. If you look at the uptrends, there's a few sectors that are still in uptrends: staples, energy, financials, healthcare, materials, and utilities. Though they managed to keep their uptrends intact, and the utility sector is the only one that managed to put in a new all-time high and a new closing high. And that wraps up Sector Spotlight for this week. I hope you enjoyed the show. Thank you for watching, and please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again in the new episode of Sector Spotlight. Next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.